Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, managing editor of ETF.com. Oh boy, what a week it has been since I last set up the microphones and gathered the team around the virtual roundtable. It feels like a month's worth of news is downloaded in just 7 days. The big story continues to be President Trump's on-again, off-again love affair with tariffs. As of this recording, midday on Thursday, it's still on. But like anything associated with Mr. Trump, it's complicated. So joining me to hash out what it all means for ETF investors is the ETF.com crack crew of writers and analysts, senior ETF analyst Sumit Roy, senior content editor Kent Tooney, financial reporter DJ Shaw, and contributing editor Ron Day. We have a lot to cover, so let's just dive right in. I'll start with you, Ron Day. Since the implementation of the first round of tariffs, the markets have been on a roller coaster ride, to say the least. You've written two stories that have resonated with readers, both focusing on the S&P 500 ETF, also known as VOO. So how does VOO embody the story that's been unfolding this past week and a half?
Well, it embodies the story about ETF investing. You look at the market, right? VOO is really tanked. It's dipped a lot, and it's shed billions and billions in assets since last week. Still, if you look at the flows chart, people are just piling money into this. I mean, like in the last week, it's net inflows of $11 billion over the past 5 days. So the market is going down. And as I related this anecdote in my story this morning or yesterday about going into my local Ace Hardware, and the guys are leaning over by the key cutter, the house key, duplicating thing, and they're talking about buying VOO, and yeah, everything's going to clear up once the tariff hysteria blows over. And this little anecdote was very revealing for what is actually going on. I mean, and full disclosure, I had told this clerk on the floor at Ace Hardware, I said, yeah, I just bought some of this too. And everybody's just kind of like a little pat on the back. Yeah, everything's going to be golden in the next few days. Well, do the toilet sound effect. It's still going down. But still, lots and lots of money going in. People are still dollar cost averaging into this massive, Vanguard fund, which is kind of like that's their legacy, right?
I have two takeaways from that little anecdote. First is, you go to Ace Hardware, which I think is great. You're supporting your local hardware store
Yeah.
instead of going to the big national box stores. Second is that it reminded me a little bit of the story of, I think it was Bernard Baruch that was getting his shoe shined just before the market crash in 29, and his shoe shine boy was giving him stock tips, and he pulled his money out of the market. Does it feel like that's something that's around the corner, maybe?
You mean a big tank, or like people
even bigger? Either a big drop or just a slow drip downward.
I did see. I mean, there's been a big. I don't want to call it a rotation, but some of the like BIL, right? The short-term bond fund has also pulled in massive inflows. So,
that's something we're going to get to in a little bit. Then I'm going to talk to Kent about. So, Kent, what did you want to say about that?
Just one thing that is kind of a stark reminder, or what the weight of this is that the tariffs now, the level of tariffs, is the highest it's been in 100 years. And I'm okay at math. I mean, that takes us back to 1925, which some like not so great things happened shortly after that. Now, I'm not saying we're headed to the Great Depression, but the thing is that's what the Treasury market does. And I know we're going to get more into that, but to me, tariffs are that serious, or can be.
So, Ron, if you were going to choose a single ETF that embodied kind of what's happening this past week or so, would VOO be the one that really kind of tells the story?
Well, I think so. I didn't look at the SPY flows, but VOO does have, it's got the inflows. I also didn't look at IVV. Those are the top 3 ETFs. But it does look like that people are still putting money into it. This resilience, they're betting on long-term A, buy the dip, A, and B, dollar cost average, and keep your eye on the long term.
Yeah, I think there's a lot of conversation around if anybody's DCAing dollar cost averaging this week, for
Yeah.
sure.
Yeah.
So you did bring up BIL, and that brings us back to bonds. Bonds turned out to be a pretty important part of what's been happening this past week. So Kent, you've been Johnny on the spot for several weeks leading up to the events of the past few days and week, writing multiple stories around how the bond market has affected ETF performance and investing strategies. And you've used TLT as your focus to convey not just what's happening, but also using it as an entree into the larger bond ETF and investing picture. So why TLT?
Okay, good point. I mean, I'll take one step back and say, we look at a lot of different ETFs, and what Ron just mentioned about the ultra short term, like BIL and SGOV flows coming into that. There's other benchmarks that we look at. When I say we, really the collective market, investors, traders, advisors like me, or writers. I'm all the above there. And so TLT is the iShares 20 plus year Treasury ETF. Its average duration is about 16 years. That all sounds confusing. So it's the long bond Treasury market benchmark.
SGOV is the shorter term, right?
Ultra short. Yeah. SGOV is like 0 to 3 months.
Yeah.
And TLT is 20-year range, but it averages about like 16 or so. And so TLT is just one of those instant pulses of how the long bond market is doing, and those yields and price action is more sensitive to what's going on. So it's really just, you can really see what's happening in the bond market by the movements in TLT. And now that earlier this week when I wrote on it, let's see, all the days just kind of blend in, but I believe it was Monday and Tuesday, the Treasury yields were spiking. I mean, the most in 20 plus years, to use that number again. And so TLT down 3% in one day. That's what the topic of that article was about, where I'm talking about TLT, but really the Treasury market. I mean, we were talking earlier this morning, and privately, but I'll share it now. I mean, the bond market is enormous compared to the stock market, way more complex. The Treasury market alone, that's not corporates, but the Treasury market alone, I just saw something this morning at $29 trillion. I mean, but why does the 10-year yield matter so much to Treasury? It's basically the essential to the functioning of the global financial system. I mean, it underpins everything from global reserves to corporate borrowing costs. So any disruption there can create a disruption in the entire global financial system. And all conspiracies aside, a lot of them sound like they could be true, but if there was a reason why Trump paused the tariffs, it would have been Scott Bessent, Treasury Secretary, talking in his ear saying, hey, this 10-year Treasury yield is a really big deal, and so we need to back off of this.
Yeah, it sounds like a little bit like they're trying to shrink the credit spread, because that could be dangerous for the economy too, because then people lose confidence in borrowing overall. I'm curious, do the ETFs that track these Treasury bills and notes, do they offer any kind of protection from some of the wilder gyrations? Or are you finding that they're tracking pretty accurately in real time what's happening? And is the best protection, if so, is the best protection possibly working with some of the inverse or leveraged ETFs?
A lot of protection inverse, but if an investor is looking for safety and yield, where there's not going to be hardly any fluctuation whatsoever, I mean, it's extremely rare that you ever see any negative price movement on ultra short-term bond ETFs. If it is, it's like 0.01% in a day, which is really nothing. So if you're talking about protection, I mean, the first thing that comes to mind, ultra short-term bond ETFs, like we've mentioned, SGOV, BIL, JP Morgan has a big one too, JPST. But that's where the safety is. But if you're betting on a movement either way, then yeah, either inverse, or if you're betting that yields are going to come back down, recession, then TLT is your better bet.
Interesting. I think you're working on a piece on ultra short term bonds, correct?
Yes, the best ones, which would be, looking at yield and all that, and also watch for a piece on IEF publishing around the time this podcast is out. That's your real 10-year treasury. If you want to track that, that's really a better benchmark than TLT.
So the discussion on bonds is a perfect entree into the next larger issue, which is the economy. So Bill Clinton, when he was running for president in 1992, had a slogan that his team used internally that became widely known and used. It's the economy, stupid. So Samit, you've been covering different parts of the sector story, like oil and how investing has shifted into international ETFs as confidence in American exceptionalism seems to have waned as the recession becomes more and more likely. What are the ETFs that tell the economic story of this past week?
Yeah, there's so many to choose from, Paul. I mean, I could point to dozens of ETFs that have been going up and down based on fluctuations in the economic narrative and things like that. Before I get into the ETFs, though, I want to mention something crazy that happened yesterday. Goldman Sachs, they put out a note, and earlier in the day, I'm talking about Wednesday, right? We're recording this on Thursday. Earlier in the day on Wednesday, they basically said their baseline forecast for the economy had moved to recession. They were now expecting a recession because of Trump's reciprocal tariffs. Then, of course, Trump comes out on Truth Social, makes all those announcements about the 90-day pause. By the end of the day, Goldman had removed their recession forecast. They're no longer forecasting a recession because of Trump's latest announcement. So this is how quickly the economic landscape is changing. It's changing every day, seemingly, based on what Trump is saying. So it's very, very difficult for anyone to really make a solid call on the economy. There's just so many unknowns out there, right? We have the tariff impact, right? That's going to be raising prices and potentially reducing demand in the economy. And then you have the uncertainty, which is causing businesses to hold off on investing. And that is also a drag on the economy. And then finally, you have the financial market impact. We're seeing spreads on certain bonds increase, like high yield corporate bonds. Their spreads have increased from 2.65% to 4.3% over the past couple of months. So all of this is kind of in the mix, and it's pushing and pulling the market in different directions. And it's just so hard to figure out what's going to happen with the economy. All we know is risks of a recession are rising. So you asked me about ETFs, Paul, and one I do want to mention is HYG. I talked about high yield spreads and how they've been widening. HYG is that junk bond ETF. It fell pretty
Junk bonds
sharply.
rear their ugly heads. Very interesting.
Yeah, yeah. And it fell pretty sharply this week because of these fears that the defaults might pick up if the economy weakens. So HYG is down something like 3% year to date now. Another ETF that caught my eye is USO. This is the oil ETF. It's down 15% year to date, and oil prices hit their lowest level since 2021 this week, which is back when the pandemic was still raging. That tells you how low we are there. Another ETF, JETS, JETS. This is the airline industry ETF, now down 25% year to date. We got comments from Delta who said that there's just too much uncertainty right now. They just can't forecast what's going to happen with earnings. They said growth is essentially flatlining and people aren't traveling as much. Another ETF I should mention is kind of the flip side of all this. We've talked about gold a lot, right? Interesting week for gold. Initially, when the market was kind of cratering, the stock market that is, gold prices also started to kind of buckle earlier this week. And the speculation was people were kind of selling their winners to raise cash for margin calls and stuff like that. So we did see gold prices sell off a bit earlier this week, but later in the week, they're back up. And as I'm speaking, gold just hit a fresh record high. So it seems like gold is once again that safe haven. And, despite Trump's latest 90-day delay, that uncertainty hasn't gone away. And that kind of brings me to something we've been talking about earlier with Kent and treasuries and things like that. People kind of lost a little bit of faith in treasuries this week, I think. And that's why we saw that uptick in the 10-year and the 30-year yield. Gold seems to be taking some of that mind share, right? As people lose a little bit of faith in treasuries, they're gravitating towards gold. And we know central banks around the world, they buy both the dollar, they buy treasuries, and they buy gold, right? These are both kind of reserve assets for central banks around the world. And to the extent that foreign central banks lose confidence in treasuries, they might gravitate a little more towards gold. And that might be kind of a tailwind for that metal, this year. I want to
So the
mention
That's part of,
yeah, go
yeah,
ahead. Yeah.
I want to inject there. I mean, that's a great point. And just to add on top of it, that's part of the reason why yields spiked earlier this week is because of a lot of selling of treasuries. And a lot of the selling could be, central banks or even just foreign investors pulling their money out of the US markets, which also pushes the dollar down, and that pushes the price of gold up. All of this is interconnected, and it's a really good conversation around how the treasury market is so important
Yeah,
to everything that we're doing here.
absolutely.
it
Yeah.
may
I
it
mean,
may be go ahead, Samit.
yeah, I mean, there's been so much talk about Trump's obsession with the trade deficit and reducing America's trade deficit. The flip side of the trade deficit is the financial account, which is all of the money that comes into the U.S. To buy investments, things like stocks, bonds, and treasuries. So if you're going to reduce the trade deficit, that means less capital flowing into the U.S. And in general, you're just making, the environment a little less friendly to foreigners and investing in the US, and that could have repercussions for the demand for treasuries from those buyers. So gold seems to be a beneficiary of that, which is an interesting thing. The last ETF I want to mention, we know how volatile things have been in the market. S&P 500 going up and down 5, 6, 7, 8, 9% every day. Well, this ETF is like 3, 4, 5 times that. SOXL is the semiconductor 3X ETF. Believe it or not, this ETF went up 55% just on Wednesday. And we're recording this on Thursday, and it's already down 25%. So it's given up half of those gains. This thing has been going up and down an insane amount every day. It's down 65% year to date. So yeah, I mean, these leverage
How
ETFs,
tied into the Mag 7 is SOXO specifically? Do you know offhand?
it's
Component
it has
wise?
one Mag 7 component, which is NVIDIA, right? It's a semiconductor ETF, so NVIDIA is the big one in there. But it also has Broadcom, which is another $1 trillion semiconductor giant. Yeah, I mean, obviously AI and semiconductors were the hot trade of 2023 and 2024, and SOXL just went through the roof. It's really the flip side of that this year. We're seeing a lot of downward moves, but also upward moves here and there as people try to buy the dip. And if you're into trading and you have a really aggressive style of going in and out of the markets, this is a perfect environment for you. And SOXL is a great tool for capturing those swings.
Definitely. In terms of flows, we also want to take a look at this. Has been a huge week. DJ Shaw, tell us, you write about our daily ETF flows, like the title says, every day, and often cover our league tables, which are based on issuer performance. So what are the trends you've seen this past week?
Yeah, so I have seen an interesting mix of flows for inflows. SPY and VU have topped the list. I've also seen a lot of inflows into Treasury bond ETFs. I've also seen flows into total stock market ETFs. And as far as the outflows go, IVV has actually topped the list so far this week. So on the opposite end of SPY and VOO. I've also seen outflows coming out of a bit of a weird mix of high yield bond ETFs, senior loan ETFs, and ultra short income ETFs.
Yeah, there's definitely a lot of activity going on in that. Any interesting asset class movements that you've seen?
Well, equities have top the list, and so have leveraged funds as far as inflows go. Outflows have mostly been focused on currency ETFs.
Interesting, interesting. So that's where the money's headed. Right. So last question. Here we go. Short answers only. Keep it quick. It's been a heck of a week. Get out your crystal ball, put on your prognosticator's cap, and tell me what's in store for ETFs next week. Kent, I will start with you. Short answers only.
More volatility.
Yep, more volatility. Samit,
More uncertainty.
good answer. DJ,
Chaos.
chaos. Interesting. And final word, Ron.
I think more flows into VOO because it's still going to be getting cheaper and it's still going to be seen as a good value. And I know that was more than one word.
I'm going to echo DJ's call for chaos. We can count on chaos for the foreseeable future. All
And
right.
they're all related.
Yes, they are. Chaos, uncertainty, you name it. They're all cousins. Yep. All right. Well, thanks to all our listeners for streaming or downloading Exchange Traded Fridays. Remember, if you haven't already, please like, subscribe, or follow us wherever you get your podcasts. If you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter, where our handle is @ETFCOM. See you next Friday.